All right, we're going to go ahead and just get started. Sorry about that. Alan's going to get us started. Go ahead, Alan.
Okay, great. Thanks, Allie. Good day, everyone. I'm Alan Bradley from the Core Group Annuity Department. I want to welcome you to today's webinar. I think you're going to find this time to be valuable, enlightening, and thought-provoking, and I encourage you to have a piece of paper handy to jot down the names of clients and prospects who might come to mind and who's going to benefit from the ideas and strategies that will be presented today. Everyone's line is going to be muted during the presentation, but we will open that up at the end for questions. Now, if you do happen to have a question that you're worried about forgetting, just feel free to use the chat box on your screen, and we'll get to it at the end or reply directly back to you after the presentation is over. So at this time, without further ado, I'd like to introduce Justin Shipman. Justin is the Regional Sales Director for Link National Life Insurance Company, and we've known him for many, many years. Not only is he an experienced and knowledgeable home office resource, he's become a very good friend and business partner of the Core Group. So again, Justin, please take it away. Thank you.
Great. Thanks, Alan, and thanks everyone for joining us today. You know, when I sit down and talk with advisors and customers, oftentimes when we look at income planning, we just look at what number is provided, whether you're using a 4% rule for distribution, whether you're taking a look at an income rider on an index annuity or even a variable annuity. People just look at what that number is. And what we often miss is the tax implications on that number. So whether a client's getting income from a trust where trusts are taxed at the highest income tax bracket, whether they're taking a last in, first out distribution from an income rider off a variable annuity or fixed index annuity, or whether they're just using that 4% rule and looking at, not necessarily looking at income tax brackets. It's something that I see that's missed oftentimes with income planning is what's the impact of the taxes. And I'm happy today to talk about a concept you might be familiar with called I for Life. It's actually an opportunity to put the tax man last, to put Uncle Sam last in line and create more income for those clients. Now, think about the clients that you might be able to help with that, whether it's limited means, whether it's a person taking income from a trust, whether it's a buy-sell arrangement, and we'll talk about that and how this can help your customers that own businesses. Getting more income means more income to the client, more insurance, maybe that life insurance policy, because bottom line, if I can increase that check going to the client, that's a good thing. And that's what we're going to do today is we're going to talk about maximizing non-qualified assets with I for Life. I'll show you how you can generate more income while the client maintains control. I think that's one of the things that people think about annuities, that, you know, to get the most income, I have to give up control. Well, this concept, this rider is not going to require your clients to give up more control. And ultimately, that just leads to more flexibility, and we'll go through that as well. So, you know, if we take just a quick look at where the market is, I mean, we know about the bear market since 2000, and now we're in the second longest bull market run. And people think, okay, well, wait a minute, I can just keep looking and doing what I've been doing, using, you know, different stocks, different equities, and you know, ultimately, you know, let's take a look. Those bond mutual funds have been performing pretty well because interest rates have been dropping down, but we're in a different environment today. Now we're in this low interest rate environment where we've seen the Treasury increase rates. That has a negative impact on those safe money alternatives, things like bonds, things like those income mutual funds or sub-accounts in different asset classes. You know, where are clients putting money? I know we still have clients that are waiting for interest rates to go up as well. So that money that's parked on the sideline, that's just been missing out on earnings, missing out on earnings, missing out on earnings. So the great thing that you get to do is offer an index annuity. Index annuities can help minimize that increasing interest rate impact, helping your clients not reduce their income, right? Because we know if you had a 5% bond and interest rates, 10-year treasuries at 3% today, well, certainly selling that 5% bond is a good thing. They'll make more money. But if it reverses and we're at 3%, now it goes up to 5%, now the client's going to have to sell that bond at a discount and have a negative impact on clients. Within index annuities, you don't have to worry about that. Even though there are different strategies, the bond impact, it isn't going to have as much of an impact if you invested in those bonds directly. And the market, we've seen the S&P go up dramatically, but I remind people back in 2000, if you retired in 2000 and the S&P dropped down, negative 49% is what the chart's showing here. How did that impact your retirement plan? Probably impacted it dramatically, right? And the benefit of index annuities is that we capture those upside, the growth when the S&P is going up, and those negative years, we just have 0% credited on the contract. Now I'm going to talk at the end about what our OptiBlend contract and OptiChoice contracts can do and some of the growth opportunities. But this is just a quick reminder that, if you're retiring on that 4% rule and the market goes down, that's a negative impact. That client just lost that income. And you can see on the chart, it took almost 10 years for the S&P to get back from where it was in 2000. And that's a long time for clients to get back to even. Well, index annuities, again, the market goes down, you credit 0, but you capture that upside potential with the growth each and every year. So, I guess the question for you is, do you have a plan to help guard your clients' retirement income against those market downturns? And for a lot of people, their answer is no, not necessarily, because how do you provide guaranteed income? Well, I know there are a couple of different strategies that are normally used when you're looking at income planning and looking at growth opportunities in that retirement portfolio. These time-tested strategies, you're probably using them in your business today, right? That dollar cost average, portfolio diversification, asset allocation classes, even rebalancing can help, but it doesn't necessarily guarantee income for the client. So where do you go from here? I guess the question is that you have a challenge, right? You have the challenge that you're trying to help your clients create the dependable income. You're looking to attract new clients. You're looking to maximize the revenue, become center of influence. You have all these different pieces going on. And oftentimes it's like, how do we make sure that the client's just keeping where they're at or actually having an opportunity for growth? Well, i4Life can actually help you with this. It can help attract those new clients. It can help increase those center of influence opportunities, because after all, if we're taking a look at that net after-tax income for a client, which we haven't necessarily talked about dramatically before, well, now it's something new. And that creates value for the accountants that you work with. It creates value for the attorneys that you work with. So, some of the clients you may want to be looking at, and really, do you have clients that are looking to maximize the net spendable income? Do you have clients with significant savings that are interested in protecting and passing their assets to their kids? Do you have a family member that is going to take income, but you're concerned about spendthrift needs, or maybe a dependent with special needs, or even someone who's interested in charitable support? i4Life can help. And the challenge for you with all these different clients is to find a way to help these clients achieve things that are most important to them, right? Like income, making sure they have enough money, making sure that they never run out of money to have lifetime income, and help them maintain that lifestyle that they want. So if you have clients that are younger than 59 and a half, that traditional retirement age, we're going to take a look at that as well. But we have some great opportunities with i4Life. And again, it's just a way where you can put Uncle Sam kind of last in line and give your clients more control and opportunities about the income that they generate. Now, i4Life does a few different things, and I should point out that i4Life is a patented distribution method only available with Lincoln's fixed index annuities and variable annuities. I'm only going to talk about the fixed index annuities today. So, the benefits that you get, or that your clients get, is not only that guaranteed lifetime income with downside protection. You can get that with index annuities, but you also get tax advantages with non-qualified money. And we'll talk about how you can get a first in, first out benefit for beneficiaries, and how you can minimize the income taxes by having an exclusion ratio. But normally when I say exclusion ratio, people think, well, single premium immediate annuity, and I have to give up control of the asset. Well, that's what makes i4Life different. your clients still maintain control of the asset. In fact, they have access to the cash values in the contract, even though they're getting this lifetime income. And the joint life coverage, I think, is a unique opportunity for you. So whether you have domestic partner clients or business owners or just two sisters living together, I4Life can help. So as we go through some of the case studies here, like Alan mentioned at the beginning of the call, please jot down those client names. We'd love to help you run an illustration, go through the different advantages that I4Life can offer those clients, because normally when you're to take a look at income riders for clients, you're limited on who you can have joint coverage on. Typically, it's just spouses. So let me show you what the benefit of I4Life is with a case study. And let's take a look at Joe. Joe's ready to turn on a stream of income. In fact, he's looking at how he can turn on income that doesn't rely on markets, right? Well, he's not comfortable with market volatility. He really wants more stability and control, and he wants a dependable income stream that he is not going to outlive. And if we can give him more control and predictability over taxes, that's really, really what he wants. He wants to maximize his paycheck in retirement. So let's just compare what type of income Joe would get with $250,000 in I4Life with the systematic withdrawal compared to a regular index annuity where the taxes are going to be last in, first out. Now, if we take a look at kind of the blue column here, you'll see the systematic withdrawal, $13,978, almost $14,000. And this is how a typical income annuity works on an index annuity and variable annuity. The gains within that annuity come out first as a withdrawal. It's a last in, first out tax situation. So with Joe, if he just used a regular income rider at a 28% tax bracket, he would end up with just over $10,000. Now, I4Life is different, and I'll use an analogy. If you take a look at the regular income rider, that's like taking frosting off the cake each and every year for income, and you don't get down to eat the cake until all your gains in the contract are gone. Then you get to go to the principal. I4Life is actually a slice of the cake. You take a little bit of the frosting, a little bit of the cake, and it minimizes the impact tax consequences because I'm reducing the gains that are being distributed each and every year. So you can see Joe's after-tax income is over $12,000, $12,743. So the difference is $2,679 more income each and every year. Now, that's a pretty dramatic difference for income for Joe and his family. $2,679 just by working with the tax benefits within this rider. I4Life offers something very unique in that you get the exclusion ratio, but still access to the cash values. Now, remember, the cash values are still have an opportunity to grow. It's an index annuity. We have different crediting strategies based on the S&P 500. And last year, one of our strategies, the uncapped strategy, credited over 13% for clients. Now, think about that. My money is still growing. I'm getting a lifetime income that's guaranteed. And you know what? If something happens, well, now what happens to cash value? Well, it goes to beneficiaries. It's just a unique opportunity for your clients to get that lifetime income. If you have clients concerned about longevity, here's a way to solve that problem. My grandmother died 1 month short of 101, and ultimately that scares me a little bit because I know I have longevity in my family. You probably have clients that have longevity in their family as well, and they're probably concerned about that. So you need to ask them about it. So let's take a look and go through the tax benefits. So again, really tax efficiencies during the income for the clients. And, so during the growth, it's the same. It's tax deferral for I4Life and that regular income rider. The income, though, is different. I mentioned the LIFO and ordinary income tax brackets where distributions with the regular income rider compare the exclusion ratio with I4Life. But when we look at the far column on the right, the legacy column, the typical annuity with withdrawal benefit receives no step up in basis. The That means that beneficiaries are going to be on the hook for all the taxes on the growth within the contract, and many companies out there force the beneficiaries to take a lump sum distribution or distribution over 5 years. The beneficiaries have to pay taxes as a lump sum or over that 5-year period. Now let's take a look at I for Life. I for Life allows beneficiaries to manage taxes on contract growth because we have a first in, first out benefit. Beneficiaries, if there's still cash value units during the access period of the contract, if there's still cash value, they can go and take the basis of the contract out. It's a non-taxable event. So oftentimes when people pass away, there are estate bills that still need to be paid. Here's a way to actually create an asset that the beneficiaries can go in, take that money out, no taxes on it, pay off whatever needs to be paid off, and then have the growth, the gains distributed over their life expectancy. It's really a unique opportunity, and this is going to help those center of influence opportunities that you have as well, because they may not be familiar with this. Now, you're probably saying, well, wait a minute, Justin, how come I haven't heard about this before, and how come nobody else is doing it? Well, Lincoln's been working with this concept and with this rider since 2000. It's only been available on our variable annuities, though, and up until the end of last year, it wasn't available on our fixed index annuity. Investors have tested this strategy as well. They put more than $22 billion with Lincoln and I for Life. Last year, we paid out over $1.5 billion of income. And we have over 121,000 consumers that are receiving I for Life benefits with a total annualized payout of 6.6% of the account value. A couple of things that you should know. Not only has this been tested, but we have a couple private letter rulings to back up this concept as well. And as you know, private letter rulings typically only apply to the people that request the private letter ruling. Well, Lincoln's actually requested it as the administrator on the contract, so it actually covers all the contracts that we're administrating. So it makes it something that you can go in with the private letter rulings to your customers, your affluent clients and their advisors or the centers of influence, and actually show them how they can, put the tax man last, create more net effective income by using this concept, and potentially pass more to beneficiaries and put the beneficiaries in a better tax situation as well. So let's dive a little bit deeper into certain client solutions. And we know maximizing income is important, but it's not always the client's primary focus. Maybe they want to help achieve the things that are most important to them, like, okay, how do I create income for someone who isn't a spouse? Or maybe I'm looking at that 1035 exchange by the beneficiary. How do we work with inherited non-qualified annuities? Or maybe they have a child that has a spendthrift need or a special need. Those trust assets, those are pretty difficult to work with if you're looking at income generation sometimes, or maybe they're just looking at retiring before age 59 and a half. These are just some of the opportunities that you can work with non-qualified money and I for Life. And let me show you, when you take a look at income before age 59 and a half, what's the challenge? Well, the tax penalty, right? And normally, if you take income from retirement assets before age 59 and a half, you can be subject to a 10% additional tax. Well, lifetime income from an immediate annuity usually means that you lose control. The SPIA is one of the exceptions within 72T, but you have to, clients give up control of the asset. And then if they do a life-only payout and they step off the curb and get hit by the proverbial bus and pass away, well, then the beneficiaries don't get anything, right? Now, I know there are other payout strategies with SPIAs to guarantee what passes to the kids, but here's a way that with I for Life, it's really considered an annuitized income stream, but it's just a withdrawal stream. And that's how come we can actually allow the clients access to cash values within the contract. We can help avoid those additional tax penalties. We can retain that upside potential and let your clients still have the ability to change crediting allocations. And having access to money, it works a little bit different with I for Life than that regular last in, first out. If I start income with I for Life, and let's just say I have 70% excluded, only 30% that's going to be taxable, and something happens where I need to take a larger withdrawal, maybe use my 10% free withdrawal, you can do that. But it's going to have that same exclusion ratio on the distribution. So if I have a $100,000 premium, and typically I'm getting $6,000 a year for income, and I want to go and take $10,000 out, well, you know what? You can do that, but ultimately that distribution is going to be 70-30, right? 70% basis, 30% gains, and it will reduce the future income payments proportionately. So since I took 10% out, it's going to reduce the income by 10%. But it's just a way that clients can keep control of the assets, help avoid the tax penalties, and maximize the income that they get. And, if you're retiring before age 59 and a half, that's a great thing to take a look at, is how do I create this predictable income stream for the client? Now, if we take a look at trust, and you probably have different clients that you work with that have money in trust, a lot of high net worth investors want to minimize the tax burden for the beneficiaries, and ultimately at the same time, it might be important to take tax efficient income to ensure assets are structured correctly to streamline the transfer to beneficiaries. And trusts are taxed at a high tax bracket, right? The growth within the trust are going to be taxed at the highest income tax brackets, and distributions from the trust may actually be subject to an additional 10% tax. Well, I4Life can be owned in a trust and can offer the same tax advantage that an individual has as well. So it solves the common non-natural owner problems with the trust, because I4Life is recognized as an immediate annuity. It benefits from the exception to taxes on the annual gains and the 10% additional tax on withdrawals. You can not only maximize that income for that special needs child, but again, I can have the payment for mom and the child because I have that joint income. So if something happens to that special needs child prematurely, and sometimes that's what happens, well, the income would continue to the mother in this case. So think about your book of business. This may be a great opportunity for you. I know I4Life, typically the average premium is way more than $250,000, because we're working with these cases. They're typically larger cases. Doesn't mean it can't help out a $100,000 case, but it creates more opportunities with some of these affluent clients as well. Now, if you have income for someone who isn't a spouse, and if you're working with business owners, think about those buy-sell opportunities where you sold the 2 life insurance policies, and maybe you set up a SPIA, or single premium immediate annuity, to fund each life insurance policy. Well, you're getting the tax efficiencies, but the business loses control of the asset. Well, if I use I4Life, I can create joint income to pay for both of those policies. And when the first person passes away, well, now I can actually have access to cash values. And think about it. If you and I are business partners and something happens to me, well, now you're going to take over the business fully, right? Get 100% ownership. My spouse gets the check, the check from the life insurance policy to buy her out. But now I'm going to create an additional pool of money for you to go do what you want with the business. Think about that, because oftentimes I may have limited what we would do within the business. You want to do something, and I said, no way, let's not do it. Well, now you have an additional pool of money because there's still cash value potentially within this fixed index annuity that you have access to. Now, I4Life allows you to structure payments, cover 2 lives. I mentioned domestic partners, sisters living together. There are all kinds of different opportunities because it's any 2 covered lives that you choose. And if you pass on, your loved one continues to receive the income, but they also have access to cash values if they want. So it's a unique opportunity that can help someone other than a spousal situation. And it doesn't say it's bad for a spousal situation. It's a great opportunity for a spousal situation as well, because you maintain control of the asset. You minimize those income taxes as well, and just get a bigger check potentially for those clients as well. And the last last kind of concept I wanted to talk about is the 1035 exchange by beneficiary. You know, until recently, if you inherited non-qualified annuities, your options are pretty limited. You may want to exchange an inherited IRA or an annuity for, you know, different features, benefits, investment options, or even more flexibility, and you really couldn't necessarily do that. You know, you would have to take that distribution as a lump sum or distribution over 5 years. The solution, well, a recent private letter ruling opened the door for post-death 1035 exchanges. In fact, Lincoln will accept a death benefit claim, 1035 the money from another company, set it up where you can actually add I for life to create that lifetime income, but also the tax advantages. So it's an ability to add an income rider on a beneficiary annuity. Now, that's pretty unique. I don't know anyone else any other company that's offering this. And again, the client's going to retain the exposure to market growth. We have an uncapped strategy. We have a great annual cap up to 6.2% being offered today. It just lets your clients have the ability to change their allocations and still maintain access to the money. So ultimately, when you take a look at what the client's going to get, remember the tax advantage is that almost $2,700 difference in Joe's case. And, you know, the index annuities, I want to switch real quick here and just pull up a PDF. So let me see if I can make my computer work today. But I wanted to go through our uncapped strategy here. And our uncapped strategy is really a great opportunity for customers today, because oftentimes when I'm working with advisors, there are a couple of different things that I hear from them. You know, Justin, I like the S&P type crediting strategy, but you guys limit the upside potential because you only credit me up to the cap on that annual point-to-point strategy. Well, a daily risk, S&P 500 daily risk control 5% index strategy allows you to get more upside potential. We're not going to cap the earnings for the client. We just tell you what the spread or the cost is going to be, and the cost is as low as 95 basis points. Now, upside potential, what's that mean? Because we're managing for volatility, meaning that we have money in cash and equities. Higher the volatility, that means more money in cash. Lower the volatility, that means more money in equities. But you can see last year, you know, for 2017, the 1-year annual return was 14.72%. Think about the clients that have, you know, conservative assets, money in a CD, money in bonds, those safe money type vehicles. What would they think if they got 14.72% in an asset that limits that downside risk, where if the markets go down, you just get 0% credited? Well, they'd be super excited, right? I mean, that 5-year annual return, 5.58%. This is just a new opportunity to help clients, you know, maximize their assets. This is what you're using or can use with I for Life as well, because remember, I for Life's the income rider, but the cash value within that index annuity still has the opportunity to grow. And if we take a look at the other crediting strategies here, OptiBlend, and we have I for Life is available on the 7-year contract and 10-year contract. And you can see we offer a couple of different opportunities, right? That fixed account, you know, up to 2.45%. The volatility control, I mentioned the spread as low as 95 basis points. Our annual cap is up to 6.2%, but we also have a performance trigger strategy that'll credit 4.5%. Now, performance trigger basically says as long as the market's not negative, we're going to credit that 4.5%. So if the S&P only went up 1% during that contract year, the client would get 4.5% credited on that contract. And that's a pretty good opportunity for those conservative clients, because if they have money in the CDs, you know, they probably don't like a lot of risk. And here's an opportunity that you can go in, show them how they can not take the risk. They have 0% downside protection, but ultimately have this opportunity as well. So let me just switch it back here. And Alan, I am going to try and make sure that we present it and put your number up, because if you have questions, you know, Alan's been a great friend and resource for a number of years here. And ultimately, I want to make sure that if you have additional questions or need an illustration on this, that you contact him or contact your regional manager. This is a great opportunity. We've talked about a lot of different client opportunities, whether it's income before age 59.5, that joint income, that trust income, or even the beneficiary annuity. And hopefully you have those clients in your book of business that you're working with today. But I4Life is unique. Use it to help that center of influence relationship. Use it to create value within that relationship. Use it to a seminar type presentation just to throw out that different idea that your clients or attendees may not be familiar with. Because I know with this concept, when you show your clients how they can get more spendable income after taxes, they're just going to like that. And for those clients with limited means, that's a great opportunity. Still maintain access and control the asset, still have the upside potential on the different crediting strategies. It can really help. So Ellen, with that, I know we're right at that 30-minute mark here. Why don't we open it up to questions? If there are any questions, please feel free to type them in the chat area. And Ellen, did I miss anything today here? Hopefully we've gone over everything you wanted me to go over here.
Yeah, you did a great job, Justin. Thank you very much. Do have a couple of things, though. Is this available for qualified money? And then the second piece would be, can this be something that's added to existing contracts?
Yeah, so it is available for qualified funds, and having that lifetime income and ability to access cash values really is a benefit. Now, you don't get the tax advantage benefits that we've talked about, but it is available for qualified funds as well. As far as being able to be added to existing contracts, unfortunately, we aren't able to add it to existing contracts. It would have to be a new contract, and you have to show the financial benefit of getting that new contract. But ultimately, it's for clients that are looking for the tax advantages, the lifetime income, the access to cash values, the ability to get the crediting strategies on the index annuity. It can help quite a few people.
Justin, we have another question here too.
Sure.
Will this work as 72Q?
So I mean, ultimately it's considered annuitized. So on the qualified money, it can help as well for that distribution prior to age 59.5. And it's a unique opportunity because, I mean, ultimately, again, still having that access and control of the asset, even though you're not getting the tax benefits, you're still getting a great benefit for that person that's younger than 59.5.
Thank you. Alan, I'm sorry, did you have another question too?
No,
Alan, did you have another question? I'm so sorry, I thought maybe you did.
No, I did not.
All right, that's all. Oh, wait, you just typed one in. You guys are hitting me up. Here we go. I can get it. Is this a good option for potentially replacing VAs with GMWB benefit equal to account values?
That's a great question. I know we deal a lot with clients that don't like the market risk, and we have seen variable annuities with the GMWBs where the clients just don't like the market risk because, after all, we've been in the second longest bull market run, and the headlines that clients are reading get people concerned about market risk. Yes, you can move money if it's a suitable situation into the index annuity like OptiBlend and put I4Life on it. So yeah, it could be a good alternative if that client's really concerned about the market risk and the cash values within the contract. You're probably going to want to see and compare the income streams. The ones that we're working with, I've actually seen where our income rider creates more income than what the VA was going to create. So we're creating more income with less market risk, and that certainly can be a suitable sale. But with those cases, we always want to take a look, see what the benefits are, and make sure that this benefit outweighs what they're getting on that variable annuity option.
Sure. I think that's all I have here. So I think we can wrap up. I wanted to let everyone know on the call that this will be available in the advisor portal on the Core Group website. Core Group, we always put up the supporting documents as well. So Justin's going to send all of those to me. So you can rewatch the webinar if you need to or share it with anyone. And then those documents will be there to download. So reach out to Alan or your relationship manager if you have any questions or you want to talk through some opportunities. We thank you all for being on this call today, and we hope you have a great day. Thanks, Justin.
Sounds great. Thanks, Allie. Thanks, Alan. Take care, everyone.
Thanks, Justin.
Bye.